In the spring of 1927, a single meeting in a Long Island mansion set a financial time bomb. The fuse was lit not by a market crash or a bank run, but by a secret loan. A $6 billion debt bubble began to inflate, propped up by a transatlantic handshake between the world's most powerful bankers. This wasn't an accident. It was a deliberate decision made in a smoke-filled room, and it would unravel the modern world. We're taught that the Great Depression started with the Black Tuesday crash of 1929, but that's just the explosion. The real trigger was pulled 2 years earlier in a deal designed to save the global economy. The very cure became the disease, a plan to save the world, destined to break it. The stage was set by the First World War. The conflict left Europe in ashes and financially crippled, with Germany burdened by impossible war reparations of 132 billion gold marks. But America emerged rich. For the first time, the United States was a major creditor nation, the bank to the world. The global financial system was a fragile web of war debts and reparations, all tied to the gold standard, a system where every dollar was backed by a physical piece of gold. This rigidity was its greatest weakness. The first crack appeared in 1925, when Britain, desperate to reclaim its pre-war glory, returned to the gold standard at an overvalued exchange rate. It was a catastrophic miscalculation. British goods became too expensive for the world to buy. Unemployment soared. Gold began to hemorrhage from the Bank of England's vaults, flowing toward the booming United States. Britain was bleeding out financially. By the summer of 1927, the British Chancellor of the Exchequer, Winston Churchill, was desperate. The system was seizing up, so he sent a covert plea for help across the Atlantic. The answer came from the most formidable economic mind of the era, Benjamin Strong, the governor of the New York Federal Reserve. Though not a household name today, Strong was the Federal Reserve in the 1920s. His health was failing, but his power was absolute. He decided to throw a lifeline. In July 1927, under the guise of a hunting trip, the world's central bankers gathered at the Long Island estate of Treasury Secretary Andrew Mellon. Present were Strong, Britain's Montague Norman, Germany's Hjalmar Schacht, and France's Charles Rist. There were no minutes kept, no press releases. The fate of the global economy was decided in secret over cigars and brandy. Their solution was simple and, in their minds, elegant. America would open the monetary spigots. The Fed would slash its interest rates. The decision made in that room was to cut the New York Fed's discount rate from 4% to 3.5%. This was the spark, but it was the kindling that already existed that would create the inferno. The American economy of the Roaring '20s was already a paradox of prosperity and fragility. Mass production, radio, and automobiles were creating unprecedented wealth, but it was wealth built on a new and dangerous foundation: consumer credit. The 1920s invented the installment plan. For the first time in history, ordinary people could buy cars, radios, and washing machines without having the cash. They could buy stocks the same way. It was called buying on margin. An investor needed only 10% of a stock's value to own it. The rest was loaned by their broker, who borrowed it from a bank. It was a debt pyramid, and with the Fed now making money cheap, that debt became irresistible. Credit was the drug, and the Fed had just ordered more. The low interest rates in the U.S. had an immediate intended effect. It stopped the flow of gold to America, but it did so by starting a massive flow of American capital out to Europe, particularly to Germany. This was the loan deal at the heart of the collapse. American dollars flooded into Germany, funding its reparation payments to Britain and France, who then used those same dollars to pay their war debts back to America. It was a circular, self-licking ice cream cone. The system was perfectly balanced and perfectly insane. This circular flow of hot money created a temporary, dazzling stability. Germany rebuilt its industry, Britain caught its breath, and on Wall Street the cheap money had to go somewhere. It didn't go into building factories or raising wages. It went into the stock market. The Fed's easy money policy became rocket fuel for speculation. The Dow Jones Industrial Average, which had been climbing steadily, went parabolic. It was a mania built on a loan. The figures are staggering. From the start of 1928 to the peak in September 1929, the volume of brokers' loans, the money lent to investors to buy stocks on margin, exploded from $3.5 billion to nearly $8.5 billion. That's over $120 billion in today's money, all leveraged against soaring stock prices. The entire market was now a Ponzi scheme, dependent on a continuous inflow of new borrowed cash. The very air was thick with greed, but the architects of the loan deal were gone. Benjamin Strong, the only man with the stature and will to possibly control the monster he had created, died in October 1928. He left behind a Fed that was rudderless and divided. The new leadership in Washington saw only speculation and sin. They decided it was time to take away the punch bowl. They would burst the bubble on purpose. In 1928 and into 1929, the Federal Reserve reversed course. It began hiking interest rates, trying to choke off the speculation. It was the correct medicine for the wrong disease. The rate hikes successfully made money more expensive, but they did nothing to curb the speculative fever, which had taken on a life of its own. Instead, the higher rates began to strangle the real economy. Consumer spending slowed, industrial production stalled, they were breaking the patient's ribs to get at the tumor. The international consequences were even more dire. The flow of American dollars to Germany suddenly dried up. The German economy, which had been artificially propped up by those loans, began to teeter. Unemployment rose. Political extremism found a fertile breeding ground in the economic despair. The same chain reaction began to cripple the agricultural sectors in Latin America and Asia, which depended on easy credit. The entire global structure began to groan. The cure had become a more virulent plague. Back in America, the final act was beginning. By the summer of 1929, the smart money was getting out. Insiders like Joseph P. Kennedy sold their holdings, later remarking that when even shoeshine boys are giving you stock tips, it's time to sell. The market became volatile, swinging wildly. The foundation of margin debt was turning to quicksand. All it needed was a trigger. It came from London. The Bank of England, still fragile, raised its interest rate to a punishing 6.5% in September 1929 to stop a fresh outflow of gold. This pulled massive amounts of capital from New York back to London. Suddenly, the pool of money available for brokers' loans started to shrink dramatically. The lifeblood of the market was being drained away across the Atlantic. The debt bubble had just been punctured. The first real crash came on Thursday, October 24th, Black Thursday. Panic selling hit the New York Stock Exchange. A record 12.9 million shares changed hands. The ticker tape ran hours behind, plunging the floor into chaos. Leading bankers pooled their resources to try and stem the tide, buying massive blocks of stock in a dramatic display of confidence. It worked for a day, but the underlying problem hadn't changed: the mountain of margin debt. The market stabilized briefly on Friday and Saturday, but over the weekend, the bad news piled up. The brokers' loans were being called in. The credit was vanishing. On Monday, October 28th, the Dow fell 13%. The confidence was gone. The bankers' pool was exhausted. The stage was set for the final utter collapse. Then came Tuesday, October 29th, 1929. It was a tidal wave with no shore in sight. On Black Tuesday, 16.4 million shares were dumped onto the market. There were no buyers, only sellers. The elaborate facade of prosperity crumbled into dust in a single trading session. The ticker tape ran until 7:45 that evening, a grim, belated chronicle of the disaster. The floor of the exchange was a scene of pure bedlam, a silent movie with the sound of tearing paper and shattered lives. The wealth of a nation evaporated in hours. But the stock market crash was not the depression, it was the starter's pistol. The real tragedy was what happened next, as the $6 billion debt bubble didn't just pop, it imploded, sucking the real economy into its vortex. The chain reaction of the loan deal of 1927 began its deadly work. The first domino to fall was the very system of margin debt that had fueled the boom. As stock prices collapsed, brokers had no choice but to issue margin calls, sell everything at any price. Thousands of investors were wiped out instantly, but this was just the first order effect. The people who lost their paper fortunes in the market were the fortunate ones. The real carnage was about to ripple outward from the speculators to the savers, from the cities to the farms. The banks were now holding the bag. They had lent billions to brokers who had lent it to investors who now had nothing. The loans were defaulting in a cascade. The bank's assets were turning to ash. The first major bank to falter was the Bank of United States in December 1930. Despite its grand name, it was a private bank serving mostly immigrant communities in New York. Its failure triggered a panic. Depositors lined up around the block, desperate to withdraw their life savings. The New York Fed and a consortium of private banks refused to orchestrate a rescue. They let it fail. The signal was sent. No one is safe. This was the critical error. The failure of the Bank of United States shattered the most crucial ingredient in any financial system: trust. If a bank with that name could fail, any bank could fail. A wave of bank runs swept the nation. Between 1930 and 1933, nearly 10,000 American banks would close their doors forever. With each closure, the life savings of ordinary families vanished. They weren't just losing money, they were losing memory. The destruction of the banking system caused the money supply to contract by a third. This was the Great Depression. It was a monetary heart attack. Without banks to lend money, businesses could not finance payroll or inventory. They slashed workers, cut production, or shut down entirely. Unemployment soared to 25%. The human cost was unimaginable. Bread lines stretched for city blocks. Men in fine suits sold apples on street corners. The pride of a nation was broken, and the poison spread back across the Atlantic, just as the flawed logic of the 1927 loan deal dictated. The flow of American capital to Europe had already stopped. Now, in a desperate scramble for liquidity, American banks and investors began pulling their existing loans out of Europe. This triggered a full-blown financial crisis in Austria and Germany, where the economies were already teetering. The largest Austrian bank, Creditanstalt, collapsed in May 1931. The European economy began to freefall. The global gold standard, the very system the Long Island meeting was meant to protect, now acted as a transmission belt for the crisis. As gold fled a country, its central bank was forced to raise interest rates and cut the money supply, crushing its own economy in a vain attempt to defend its currency. It was a worldwide deflationary spiral. Nations turned inward, erecting massive tariff walls like the Smoot-Hawley Act, which only strangled global trade further. The world was fragmenting into warring economic blocs. The political consequences of this economic collapse were as profound as they were predictable. In Germany, where hyperinflation in the early 1920s was still a fresh memory, the Great Depression destroyed the faith in the fragile Weimar Republic. Middle-class savings were wiped out for a second time in a decade. Desperate people turned to radical solutions. In 1933, Adolf Hitler and the Nazi Party rose to power, their promise of national restoration resonating with a bankrupt and humiliated populace. The seeds of a Second World War were sown. The same patterns, different faces. So, what are the lessons written in the blood and ink of the 1920s? The first is that bubbles are never about greed alone. They are about systemic incentives. The Fed's artificially low rates in 1927 created an incentive to speculate that was simply too powerful for the market to ignore. It was rational until it wasn't. The second lesson is that debt is the hidden accelerant. The $6 billion broker's loan bubble was what turned a market correction into a systemic collapse. When the asset backing the debt falls in value, the entire credit structure collapses. Leverage is a silent killer. The third and most important lesson is about the fatal delay. The men in that Long Island mansion saw an immediate international problem: the gold drain from Britain. They applied a short-term fix, lower U.S. rates, without any regard for the long-term domestic consequences. They saved the world for 1927, but destroyed it for the 1930s. This is the perennial error of central banking, fighting the last war. We are always solving the previous crisis. Now let's pull the camera back. See the pattern. The 1927 loan deal was not a unique event. It was a classic example of a moral hazard where a short-term bailout for one part of the system encourages reckless behavior everywhere else. We saw it in the 1980s with the savings and loan crisis. We saw it in its purest form in 2008 when the collapse of the subprime mortgage debt bubble, another pyramid of leverage, triggered a global financial meltdown. The names change, the mechanics remain. Today, the scale is magnitudes larger. The global debt burden has swelled to over $300 trillion. We have witnessed over a decade of near-zero interest rates, a policy response to the 2008 crisis that mirrors the easy money of the mid-1920s. That tidal wave of cheap capital inflated asset prices everywhere: stocks, real estate, crypto. It created its own dizzying array of leverage, from shadow banking to derivative contracts. We are living inside the Long Island deal. The trigger is never the same twice. It wasn't a bank run in 2008 that started the collapse. It was the failure of a single investment bank, Lehman Brothers. In 1929, it was a rate hike in London. The next trigger could be anything: a sovereign debt default, a geopolitical shock, the failure of a key institution. But the underlying condition is always the same: a mountain of debt built on a foundation of artificially cheap money. The system is primed for a chain reaction. So, what is the actionable insight? You cannot time the collapse, but you can understand the architecture of the trap. First, recognize that the financial system is a web of interconnected promises, and debt is its weakest link. Second, see that central banks are perpetually trapped in the same cycle. They use easy money to solve a crisis which plants the seeds for the next larger one. This is the wheel of fire. Your defense is not prediction, but preparation. Deleverage, reduce your own exposure to systemic debt, own tangible assets that exist outside the digital ledger of the banking system. Understand that the goal is not to get rich in the next boom, but to survive the next bust. The winners in 1929 weren't the ones who predicted the crash. They were the ones who had no margin debt, who held gold, who had a farm to return to. Build your lifeboat before the storm. The story of the 1927 loan deal is the story of modern finance. It is a cycle of intervention, distortion, and collapse. It is a tale of brilliant men solving one problem while blindly creating a far greater one. It is a warning that the greatest dangers are not the visible shocks, but the hidden, interconnected dependencies that we build in times of peace. The $6 billion debt bubble of 1929 is a ghost that still haunts every central bank meeting, every market rally, every moment of false prosperity. The past is not a prologue. It is a blueprint. The pattern always completes. The debt always claims its due. If you learned something new today, hit subscribe. There's always more history waiting to be uncovered here on Econ Prime.